Hey, welcome again, everybody, to Advanced Option Strategies. We do this each week, and glad to be with you today. You know, each week we demonstrate different option trades, and very often I use that risk profile tool on thinkorswim, and it's just kind of a part of what we do almost every week in this class to one extent or another. And so I've gotten some feedback of some of you saying, look, I want to know, I kind of get it maybe, but I'd really like a tutorial almost on the basics of using this risk profile tool. So that's what I want to do. I kind of want to build up from the ground up using that risk profile tool, but I want to be very practical about it and look at different trades today and potential, sample example type trades today using that risk profile tool and really get your questions answered on that. But to do so, we'll go through that in just one sec, but I'm also happy to announce that Barb is helping me out in the chat today. I always appreciate Barb. Very knowledgeable on thinkorswim, very knowledgeable on options. And so I'd encourage you to follow her on X and follow me on X as well, at Brent Moore CS, at Barb Armstrong CS. And there we go. Let me just mention a couple other things. One, options do carry a high level of risk and are not suitable for all investors. The information today is for general informational purposes only. It's not an individual recommendation or endorsement of any particular strategy, chart pattern, or investment, particular investment. We don't recommend, Schwab does not recommend the use of technical analysis as a sole means of investment research. The paper money application is provided for educational purposes only. And for the sake of simplicity, we're not going to factor in commissions or fees into the trades we're doing today, but just realize that is something to pay attention to. All investing involves risk, including loss of principal. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And I think we'll leave it there and get to the heart of the matter here of what we're trying to get to. So I'm going to bring up that thinkorswim platform. So I want to kind of give you a tutorial for the risk profile tool, discuss how it can actually help you in your trades, but I want to use trade examples along the way to help you in the process. Now, one question I got in a different class, but I'm going to kind of address it here because I want to add a trade in, is I'm going to put a link in the chat as well to those of you who are interested. I talked about trading index options on Wednesday in my Managing an Options Portfolio webcast. And I just put a link in the chat for those of you who are live. For those of you who aren't live, you can always go to Trader Talk's Schwab channel, go to the playlists, and just go to that Managing an Options Portfolio playlist. And there on, let's see, February 19th, I have a trading index options class. Because one of the questions I had, I showed options, trading options on SPX and then XSP as an alternative to that. This is a micro index option, so it doesn't move as much. Percentage-wise, it moves the same, but just the dollar amount, it's not as big as the full contract. And the question came up of, are there analogous type micro contracts for other indexes? Yes, there are, is the answer. So instead of the INDX, which is the NASDAQ, there's the XND. One challenge with the XND is the contracts tend to be less liquid, is something I found. Instead of the RUT, which we did an example trade on the other day, you could use the MRUT, which is another example. And so what I'm going to do is I'm going to do a trade on the MRUT here just to start us off. And John's saying, what do I mean by index options? Index options, indexes are measures that track the market, ways of tracking the markets. And when we say the S&P 500 index, it's a way of tracking the whole market, the S&P 500 in that case for the S&P 500. Instead of trying to track all 500 stocks, we can do that there's other measures we can use to track other things like the NASDAQ 100 or the Russell 2000. Instead of tracking 2,000 stocks in the Russell 2000, we use an index or a benchmark, if you will, in a sense. Well, here we have this IMRAD, and I'm going to take a bearish approach to this as we start out and look at this risk profile tool. So if I wanted to do a trade, and I'm going to start with a simple trade, I'm just going to do a simple long put, and then we'll build from that. But I can go to the trade tab, and I'm going to go out, we'll go out to, say, March 14th. Okay, I've got those open anyway here. And I can go to those puts, and I'm going to buy a $224, no, I'm not going to buy a $224 put. This thing's dropping. I'm going to go down to we'll go $221 put. And I'm just going to click on that ask price there. So if we were just to buy a put, we're going to do it that way. Now, this class is more of an intermediate level class, so I assume you know what a long put option is. Here's a long put. We're just, instead of using the individual stock, we're using it on an index here. So here we go. Now, if I want to look at this trade in more detail and take it to the risk profile tool, instead of just sending that trade, one thing I can do is I can right click on it. I can click on Analyze Trade. And what it's going to do is it's going to bring up a graph for this trade that demonstrates the risk. This is the risk profile. It demonstrates the potential gains and losses on this trade. Now I'm just going to do this for a sec here. I'm just going to move this over just a little bit here. And let's talk about this page that we're going to see. As we look at different trades, I'm going to build on it and look at different aspects of this. If we're going to start off with this, let me just mention this. The y-axis, or this vertical axis here, represents profits or losses. Okay? That's the first way to read this, profits or losses. So where's break even? Break even is this zero line. Any data point above this zero line on the graph, any data point up here is a profit. Here's the zero line. Any data point up here is a profitable area that we want to see. Okay. Similarly, losses, that's a minus 500, minus $1,000 loss there. You can see those represented right there. That's the y-axis. That's probably the first thing you need to look at. What about down here? What are these numbers down here? These numbers represent the underlying stock, or in this case, index price. So let's say that underlying stock goes down to, or index goes down to $213. Okay, so we're down here. And we're looking at our lines up here. And right now I'm going to concentrate on this blue line. I can look at this blue line. Is that blue line above or below the break-even point? It's below. It's above it. That means it's profitable at that point. As this is hypothetical, this isn't exact as to what the stock price option is going to price at a particular price, but it's a pretty good estimation here for trying to help us with this trade. So one thing we can tell with this long put trade, and if you're not familiar with long puts, if you were to look at this and go, what's my profit potential on a long put? If I were just to kind of scroll down and look, the further this stock goes down, look, the further this stock goes down right here, what's happening? We're making more and more money. That's one of the advantages of long puts, okay? The more the stock moves, the more money you could potentially make. At a certain point, it caps out at zero, but that would be a very high gain. Similarly with the long call, which I'm not going to go into right here, but it just flips the graph around, and the more the stock goes up, the more and more money you potentially make on this trade. That's a great thing, and that's why you may consider at times doing a long call or a long put because of just the pure profit potential they make. All right. Now, I'm going to get to the purple line later. Don't worry about that right now. I just want you to worry about this blue line right now. Now, what's the most we can lose at this? Well, notice what the blue line does. It kind of comes here and then it just kind of flattens out. And it doesn't matter how much this goes, this we're right at we're at about $480 is the most we can lose. It doesn't get worse. It doesn't matter how much I scrolled up that page, it would still be at $480 because the most you can lose on a long put or a long call is the amount you pay for it. And in this case, the price was $480 for this option. So putting it together here, this graph gives us an easy way of finding what our profit or loss potential is for different prices of the stock or index along the way there. That's how that works. Now, where's the current price? Well, the current price is represented right now with this dashed line on here. I think you can probably see it. I'm going to put a little arrow on it. That little dashed line, I'll kind of draw over it so you can see it a little bit. That represents where the stock currently is. And this represents kind of the downside maybe of a long put or a long call. You can see where the stock currently is. Where's our blue line? It's right down here. We are firmly in loss territory on this, okay? So one of the advantages of a long put is the potential gain we can make. What's one of the disadvantages? The disadvantage is we're going to start in a losing position, and therefore we need the stock to move quite a bit. It's not going to be a high probability trade because if it just kind of sits where it's at, that's not in great shape. We need it to move. And the same thing is true on the other side for a long call. Okay, now there's a lot of other aspects of this tool, this risk profile tool, we're going to get to today. But I just wanted, that's the most basic stuff I think I could talk about here on this for this initial trade. We're going to look at other trades as well. But if I wanted to do this bearish trade, well, I can go back here. Remember, to bring that to the Analyze tab, all I did was I just right-clicked on it and I confirmed and sent it, okay? So what I'm going to do here is I'm going to confirm and send this, and I'm going to actually send that trade. Now we've sent that in there. Now, if I go back to that Analyze tab, notice it's still there because the risk profile will show both potential trades and trades that you're already in. So let me get rid of this for a sec. Notice it's showing that trade because we just entered that trade. And so you can view your existing portfolio here on the Analyze tab. All you need to do is bring up the stock that you want to look at up here. And if it's in your portfolio, this is a paper money portfolio. If it's in your portfolio over here, it should show on that Analyze tab. Okay, let's look at a different trade here, just as a different example. I'm going to go slightly, we're going to add another leg onto this. I'm going to bring up Coinbase. This is a kind of a popular type stock here. Let me get rid of that volume profile for a sec. I'll probably go back to that volume profile in a minute. But here's Coinbase. And bullish or bearish. This is similar to a trade I saw demonstrated earlier today. Someone was showing a trade earlier today. And this isn't, I don't know, this may be, actually this is one that I think I saw earlier today, perhaps. I'm going to do basically the same thing. But the take they did on this, their take was, this is kind of a bearish trade. And you can kind of see that. Kind of that's the trend. And so what they did was a short call vertical spread on there. Short call vertical, and they did it at the 280, and they put a strike. They sold at the 280. I call it 280. I'll just kind of mark where that is. Sold, bought a call at 290, and they want the stock to stay below that 280 level. So for bearish traders, if they thought this stock was going to stay below that 280 level, this would maybe be an example trade. So let's look at this as an example trade. And in fact, I think I may already have that in there. So what I'm going to do is I'm going to go straight to that Analyze tab. And I've got Coinbase in here. And actually, I don't have it in there. So here's what we're going to do. We're going to do what we did before. I'm going to go to Coinbase. And it was a March 21st expiration they were using. Again, bearish trade, and it was a 280 and 290 call. So I'm going to click on the bid price on my 280. I'm going to control click on the ask price of my 290. I'm going to do what I did before. I'm going to right click on it. I'm going to analyze the trade, and I'm going to bring this in and just kind of tweak this a little bit. I'll talk about tweaking it a little bit later. But here we go. Now, let's take what you know about that. Actually, let me tweak it a little bit more just so we can look at it. I want to take what you know about this graph already and talk about our profits and losses potential. Here's our potential profit, $1,000, $500. Here's our break even. I'll put a little dashed line here on this. There's our break even, and here's losing, okay? And what we can see is, we can see if the stock goes up, what happens? Well, it starts to get worse on us the more the stock goes up. And then at a certain point, it kind of caps out. It goes flat right here. We can see that cap out. If the stock goes down in price, if Coinbase goes down in price, at a certain point, it's profitable level and it caps up there. Now, here's another thing I want you to see. Look at the difference between where the current price, I'm going to just tweak this just a little bit more, maybe to make this a little bit easier to spot. Here we go. Okay. Look at the distance between the break-even price. I'll put a little dash line where that break-even price is, because remember, that's right here where break-even is. And our max gain, which is right there, and our break-even price, and our max loss. Which has the bigger gap? Well, the loss has a bigger gap, doesn't it? That is a bigger gap than, I can't even draw it in here, than that there. So we are currently risking, we have the potential to risk more on this trade than we potentially gain on this trade. That is pretty standard with the short call vertical that is done out of the money. Now, so if we potentially lose more than we potentially gain, why would anybody ever do this trade? Well, one answer is this is our current price. This is where the stock currently is, this little dash line right here. This is where we're at. Notice if the stock goes down, we're at a positive position. We're above zero on here. If the stock stays about where it's at, we're at a gain. We're at a positive position on this. What if the stock goes up? We're actually at a positive position. We're at a gain to a certain extent, unless the stock goes all the way up to 280, then it starts to decline and we get to a losing position. So, moral of the story, short call verticals, short put verticals, if we do them out of the money, typically they're going to be higher probability trades, but it comes at a cost. And the cost is we potentially lose more than we potentially gain on. Okay? So now on this, let's talk a little bit more about this using this risk profile tool, because there's some other features here I want to talk. I mentioned this is the break-even point. Notice we have other lines here. These lines correspond to what we call price slices. Price slices represent just different scenarios of where the stock could potentially be. And we can, this is where we can see what we can put in different scenarios here. So we can say, if the stock is where it's currently at, we want to see what the option Greeks are for that. We can see what the profit loss is for that, and so on. If the stock goes up 10%, then we can see what the option Greeks are for that. Or maybe not 10%, maybe it's some other number you want to put in. Let's put in $290 here. I'm just going to type in 290. And I can see, what would my profit or loss be at 290? Oh, it shows right there. Or if you want, instead of typing it in right there, you can scooch it with your cursor, with your mouse. You can just click and drag right there if you want. You can move this line to different price slices. Now, if I just add a price slice, what it's going to do is it's going to add it in right at that 0 mark, right where the stock currently is. And if I want to get rid of one of these slices, I can just go to the right portion of this page and I can delete that slice. You can change these slices to where you want. Now, in the chat Leon says, it seems like it's not telling the whole story. Well, no, it doesn't tell everything because we don't see the technical analysis behind the stock here on this. But let's talk about so far what we could tell from this, okay? And why this risk profile tool is a great possibility to help you analyze trades. It shows you where the stock is. It shows you what our max gain is on the trade. It shows you what our max loss is on the trade. It shows you visually, and we'll see this a little bit more later, it shows you visually where it's profitable and where it's a potential loser on the trade. And we can actually see the probabilities of it in terms of what are the odds of it going up higher and odds of it going below a certain price. I haven't showed you that odds thing yet, but I'll get to that in just a little bit. But just for now, you know the basics. Now you know how to add price slices in. You can always click on the plus sign to add another price slice. You can delete them by going to the right side of the page. You can move these around to wherever you want those price slices to be. And of course, you can add in those price slices right here. One important factor, though, that you need to do as you're doing this page is there's dates up here. And we're going to look more at these dates in here just a little bit. But one thing that we're going to start off with is start off with your current date right down here. Today's the 21st of February. Today is the 21st of February. And if we don't have that in here, look at the purple line. Now, we haven't gone to that purple line yet. I'm going to tell you more about that purple line in just a sec. But if you look at that purple line and I adjust the date down here, so you're going to let me adjust it. It's off the screen just a little bit here. Let me just, come on. Okay, well, let me do it this way. I have a larger font on this than I normally use just for demonstration purposes. But look what happens if I go to, say, 228 here. Oops, not 228 on here. Look at what happens to that purple line. Did you see that? It just shifted. It just shifted on me. So it's important to have our current date down here, okay? And then for the date in the upper right portion of the page, what we're usually going to do is we're going to go to 1 day past our expiration here on this, okay? Our expiration is March 21st, so I'm going to go to March, oops, wrong thing. I'm going to go to March 22nd, right there. And so we can see our graph there. Now, question is, how do I decide between a short call vertical and a long put vertical? Good question from Gazelle in here. And it's beyond a little bit what I'm going to get into today, but let me give you a brief answer here on this. The risk profile is going to look very similar on a short call vertical and a short put vertical. We have and a long put vertical here. The biggest difference is going to be the strike prices you choose. Okay? The biggest difference is going to be the strike prices you choose. If you choose the exact same prices, they're probably going to look very, very similar to one another. They're probably going to have a very similar max gain, a very similar max loss. But since we're doing this trade where the stock, we wanted a higher probability trade where the stock price is below the current strike prices, we did a short put vertical. If we did that with a long put vertical, those contracts would be in the money right now. And so I'm avoiding it right now on that. I have done classes in the past, webcasts in the past, on the difference between long verticals and short verticals. You can just use the search tab, go to the Trader Talks channel, use the search tab and type in long verticals versus short verticals, or long verticals, short verticals, and I go through a whole session kind of discussing the differences between those. But from the risk profile perspective, they're going to look identical almost if you have the same strike prices there, Gazelle. Okay, now, here's another thing I want to show you here before I move on with this. When you are looking down here, I'm going to crunch this up just a little bit because I want to show you at the bottom of the page here. If I go down here, I'm going to remove my ticker down here, and I look down here, I can see different trades down here. Okay? These are trades, the ones that are just in the black plain color. These are the ones that are currently in this portfolio. This is a paper money portfolio, so there's sample trades here. They're not recommendations, but you can see those. But when I scroll down, oh, look, this one's in a reddish color. That means it is a simulated trade. It's not an actual trade I have in. If I keep scrolling down, oh, there's another one. We have a simulated trade in Disney, Intel, and SPX in green. That just means it's a debit transaction, okay? And so I have these different trades here that are simulated trades. And if I want to get rid of any of these, I can just X them out right here. Notice on these ones that are in black, I can't X them out because they're a trade that we currently have on. We can't just delete it. Now we can choose not to look at it. So if I go to Visa, I'll just pull this up real quick. I have a graph up here. Okay, I have a graph up here. If I want to look at it without it, I can just uncheck. I can uncheck it and notice it disappears up here. So you can look at these right there if you want and look at both trades that you currently have in and trades that trades that are simulated trades. All right, now let me just see if there's anything else I want to cover right now on this. Oh, yeah, one other thing. Let me go back to Coinbase here before we move on. One other thing before we move on. Here's the trade we just looked at. Now, if I wanted to add a break-even price, it's not just the current, let me just move this down a little bit here so you can see a little bit better. It's not just the current price or these kind of arbitrary prices you have right here. You can also go over here and add in break-evens here. If I want to know what my break-even is, I go to this little 3-line menu right there, click on that, and I can set my slices to break even. You can say, oh, what's going to be my break-even line at expiration? Oh, it's right there. It's right there. My break-even line's right there. Now, this is a higher probability trade, and I can see that by looking at my percentages right here. There's about an 80% chance of it being at this price slice or less, about a 20% chance that it's above this price slice. This price slice is my break-even point. So can you see how we can actually look at probabilities on this page? What are my probabilities that this stock is going to be at, say, 240 or less? Well, I can just add a price slice on there. I just clicked right down on there, and I can see, oh, there's about a 53% chance this stock is at 240 or less here, because I add that price slice on there. What are the odds a stock is going to be between $240 and $250 at expiration? Well, this is just an estimate. It's nothing exact here. So if I click on 250, let me add another slice on here at 240. And if I want to get this exactly at 240, I'd probably have to type the numbers right in here. And I can do that if I want to, but just for time's sake, I'm not going to. The odds of it staying between 240 and 250, about 8%. Okay. The odds of it being below 240, about 55%. The odds of it being above 250, about 37%. Probably the most common price slices you're going to use, though, are either the current price or where break even is. I showed you how to add break even in there. Or sometimes it can be helpful, I think, to go over here, set slices, and you can say, you know, I want it at break even, but I also want it up 10% and down 10%. So what's that going to do? That's going to add 3 price slices. Break even, which is the 0 mark, up 10%, down 10%. Here's my 3 slices. Current price, up 10%, down 10%. So to get up in this range where we're losing on this, we'd have to actually go up quite a bit more than 10% on this. All right? Now, so we talked about adding break-evens in there, adding different slices. And now one question I should answer is this. Let me set slices, and sometimes people see this little sigma, this is just a Greek letter, okay? And you can go up here and you can say -1 sigma, what's this? This is just a standard deviation. Let me just move this in just a little bit here because I want to get to some other trades here. But this is basically putting a price slice at a 1 standard deviation move up, a 1 standard deviation move down, all in all, 68%, 1 standard deviation. Now, let me also mention this. Notice the shading on this graph. This goes to PBG. It says, what's this kind of gray versus the black background? That represents a 1 standard deviation difference, movement of this stock. Our stock is currently right here, okay? Our stock is currently right here. This is where we're currently at, okay? Now, it can go up or it can go down. It can go up or it can go down, but there's about a 68% chance it stays within this gray area right there. Now, can I change that 68? Can I change that gray area? I sure can. I can go up here and let me get on my drawing tool and I can change this and say, well, I want to go up to like 2 standard. We're going to go 95% here, okay? Here's 95%. Look at that gray zone. It's a much bigger area now. 95% chance, according to this model. This model isn't a guarantee. According to this model, 95% chance we're going to be in this gray area right here. So that, hopefully that answers your question of that gray zone versus the black zone there. And very often, what we'll do is we'll just kind of have it as 1 standard deviation right there. Okay, and that's where we often look at our price slices. Okay, so here's what I'm going to do. I'm going to go back here. We're going to place that trade. Okay, I'm going to confirm and send, and I'm going to send that order, and we just put that in. Okay, I'll put that in the proper group later, but because of time's sake, I want to keep moving here. Let's look at another trade. And this is one I was actually looking at earlier today. And this, of course, is just an example trade. I was looking at Oracle, and my thought was, in fact, I was viewing the volume profile here on this. And this is a stock that has been kind of up and down, volatile. The volume profile shows most of the trading has been kind of in this area here. Just about, right now we're at 169. It's dropped quite a bit since I was looking at it earlier. And what I was looking at earlier was maybe doing like a $170 calendar spread on this. And actually, it was up here when I was looking at it earlier. I'm still going to look at that 160 calendar, that 170 calendar, because this is kind of the range. My assumption, my technical analysis assumption is we kind of, oops, where'd that go? Is, you know, we kind of have a range here on this, and we're probably going to stay somewhere in this middle of the range, around the 170 level. Okay, so let's do that. Let's look at a calendar spread on this, and so I'm going to go to trade, and I'm just going to put in that calendar spread. And by the way, if you're going like, what's a calendar? I want to learn more about calendars. I'm not going to go much into calendars here because that's not the focus of today's class. But if you look back in the playlist for this class, and I'll post it in the chat, I go just look in the history. There's calendar spread. We go through it. Otherwise, just go to the Trader Talks channel, and you'll see in the history that we go through calendar spreads. But here's what I'm going to do. I'm going to go to a March 14th. I'll do a call calendar because I want to keep them out of the money here on this. Let me get fewer strikes. I'm going to do a call 170 calendar. I'm going to click on the bid price. I'm going to go down to April 17th. I'm going to go to the 170. I'm going to click on the ask, control click on the ask price. There's my calendar spread on this trade, okay? Let's analyze it. Let me right click on this and I'm going to analyze trade. Now, by the way, if you don't start on the trade tab and don't, what I've done is I've started on the trade tab. I've right clicked on it, okay? I've right clicked on it and clicked analyze trade. If you want, you can go straight to analyze trade, go to add simulated trades, add it right. This is going to look just like the trade tab, right? You can add your simulated trade here and then click on risk profile. But I just added it in over here, okay? So here's my calendar spread. Now, let's talk about this. Pros and cons of a calendar spread. Well, you can see very clearly where our max gain is. It's right where our strikes are, 170, 170. That's where it peaks out. The odds of hitting that peak right on the nose, probably not exactly. But, hopefully we're in this range somewhere. This is where we want that stock to be. I'm going to go down here. I'm going to double check my dates. March 21st. No, March 14th. Well, excuse me. Here's today's date. And then I want to go to the day after expiration, which is March 15th. Okay. Why the day after? If you go the day after, it encompasses all the way to expiration here. Now, I haven't talked to you about this purple line. Let's talk about this purple line here. The purple line represents what this profit or loss is right now. We've been talking about the blue line. The blue line represents at expiration. But notice, right now, if I were to take that stock, let's just go and add I just want to add current price. Here's our current price right here, okay? Right now, if we enter this trade, are we going to be at a huge winning position right now? No, we're not. That's what this line would indicate. That's at expiration. At expiration, if the stock stays right at 168.5, we're in great shape, it looks like. However, at expiration, that's a ways away. Right now, it's showing us about break even. Okay, that's what the purple line represents. It represents this date right here. Now, what happens? There's a difference between where we are now and where we are at expiration. What happens during that time? Time decay happens. Theta happens. What happens if we go and go forward in dates? Now, I'm cut off because of this font I'm using, the font size I'm using. Okay, but here's what I'm going to do. Look at what happens as we go forward. Let me go to, say, March, we'll say March 5th. Okay. Yeah, March 5th. Look what happened to the purple line. That difference between where the purple line was, which was down here, and where it is on March 5th, I'll put little dots there, represents time decay. We're benefiting, that's positive theta. That's time decay helping us out. Calendar spreads are positive theta. That's another thing you can tell on this risk profile tool is you can see where positive theta is and where negative theta is. If this purple line is above the blue line, it actually turns into kind of negative theta there. It's just a little bit, not much. But here, anywhere where this blue line is above the purple line, as we get closer to expiration, that purple line is going to kind of morph into the blue line. It's going to get closer and closer, and eventually at expiration, they're going to be the same thing. That represents time decay on your side. And so if we were to hold this all the way to, say, just a couple days before expiration, let's do that. What just happened? Oh, I went past expiration. That would explain why that isn't looking right. Now, look, you see it's gotten closer. That purple line's even gotten closer. So that's the time decay element there. Okay, that's the time decay element. Okay, Leon says, what about March 15th? Well, March 15th, why did this whole graph just kind of mess up? Well, when I went past expiration, because at expiration, this short contract would expire, and all I would be left with would be my long contract there on that. Okay, so that's what that is. All right, question in the chat. Is this also a diagonal? This is not a diagonal. Diagonals have different strike prices, okay? This has different expiration dates, just like a diagonal, but it has the same strike, so this is a calendar spread. All right, so let's see, what else do we want to talk about? We talked about probabilities already. You can adjust those probabilities. Let's set our slices here to expiration, just to take a gander at that. Set slices, break even at expiration. Hold on. This has to be today's date, which is 2/21. Okay. And we can see what our probabilities are on this trade there. Okay. What are our probabilities? Our probabilities about 6. Here's our break evens right here. Okay. Here's our break evens. Break even 1, break even 2. There's about a 64% chance it stays within those between now and expiration there. So you can see that's a higher probability trade. Okay. Calendars. Now, as I mentioned before, we've done calendars before. Look back at some of those calendar webcasts, but typically we're not going to wait all the way till expiration. In fact, what I'm going to do here on this is I may look to, even look to roll this out. As this one gets near expiration, I may roll it towards a March, I don't know, 30th, or I don't know what the date is going to be, expiration there. Okay. Now I have just a couple minutes left to go. Let me get out of this, and I just want to show you, I want to add this trade in first of all. So I'm just going to right click on this. I'm going to confirm and send. I'm going to send that trade. There's one other I want to look at. There's one I was looking at earlier. This was actually a trade that I was looking at from somebody else earlier today. But this is a butterfly spread. And this is kind of the last thing I want to show you here on these. Now, if you ever want to adjust this graph, you can, if you grab it by the kind of the numbers down here, you can kind of adjust the scale. Do you see how you do that? If I want to drag the whole graph, don't grab it by the numbers, just grab in the middle of the graph and drag it left or right. So you can do that way, okay? This is what we call an unbalanced butterfly. Okay, again, I'm not going to get into the details of the trade here today because our goal is to look at this risk profile graph. You can see it's unbalanced because my strike prices, a normal butterfly, I'd have an equal distance between the middle strike and our high strike and the middle strike and our low strike. But this is the kind of final main thing I want to mention about this risk profile. On basic trades, long calls, long puts, maybe even short call verticals or long put verticals or whatever, it may be pretty intuitive to you as you get more experience where our max gain is, where our max loss is, what the probabilities are, and whatnot. On this, but when you get more complex trades, such as a broken wing butterfly, which is what we have here, it's not going to be quite so obvious. What the risk profile tool does, it helps you to visualize, well, what happens if the stock goes up? Look, if it goes up, it doesn't matter how much it goes up. I'm in good shape here. I'm above my break-even line. If it goes down, that's not in such great situation. Where are we currently at? We're currently at a losing situation right here. What we want ideally is for it to go up a little bit. If it goes up too much, well, that's not too bad. That's not a terrible situation, but ideally it goes up in this situation. But if it goes down, then that's not a good situation. We can adjust these and look at the probabilities. Remember, I don't have time to do it today, but remember, if I want to look at those probabilities, you got to adjust this to your expiration date or 1 day beyond expiration. So I put March 22nd in there, and then I can check out my probabilities and I can adjust my slices to wherever I want it to be. Okay? Now, my goal today wasn't to, go into the depths of butterflies or broken wing butterflies or calendar spreads. That wasn't my goal. My goal was to give you an introduction to this risk profile tool by looking at actual trades, actual sample trades, example trades. If you go to the playlist, I have classes on butterflies, I have classes on calendar spreads you can go through, and next week we'll resume with other looking at specific trades here. Coming up next, we have ThinkStrip studies. Make sure you check that out. Barb, thank you for helping me out in the chat. Thank you all for joining me, and we will see you all same time next week. Bye-bye, everybody.